let me now move to our second speaker, that is Masaaki Maeda. He is the president and CEO of NTT DOCOMO USA, which is a wholly owned subsidiary of NTT DOCOMO Japan. It is Japan's leading telecom company, and he concurrently holds the title of Associate Senior Vice President in NTT DOCOMO, overseeing new business development in the Americas. Mr. Maeda began his career in the Japanese telecom industry at Technical Development Department of NTT. In September of 2009, Mr. Maeda opened the first NTT DOCOMO customer service counter in the continental US, aimed at providing a seamless user experience to customers traveling to North America. In April of 2011, Mr. Maeda launched a new wireless service, DOCOMO USA Wireless, aimed at Japanese expats in the US. Mr. Maeda holds a bachelor's and a master's degree in electrical engineering from the Tokyo Institute of Technology. In addition, he is actually an alum of MIT, and he earned his MBA from the Sloan School in June of 2002. With that, I leave the floor to Masaaki.
Thank you for introduction. When I was Harvard Business School as a panelist, everybody say my introduction, boo. I'm very happy. I have no booing today. Okay. My name is Masaaki Maeda from NTT DOCOMO USA. As she explained, we are 100% owned by NTT DOCOMO. Okay. I have just 5 minutes, right? 5 or 10 minutes. Okay. I have a lot of the slides. I would like to explain like a shotgun. This slide shows about NTT DOCOMO. NTT DOCOMO is one of the biggest telecom cellular phone operators in Japan, almost 50% of share. Almost 100% 3G subscriber. iMode is a mobile internet service, almost 87%. And it's flat rate, 65, very educated. And this is the figure of data service, the total output. We started iMode in 1999 and reached to 52% of output. And now Verizon or other US carriers and catch up even 37% or to 30%. Actually, as you know, we are very data adequate subscribers. Actually, as you know, the Japan market is convert from iMode, the smart normal phone, to the smartphone. But I would like to say, Japanese phone is already 100% smartphone already. Actually, the style is from the different to the smartphone. We are starting from iMode service in 1999. It's the belong to content or email services. And they were converted to smartphone platform like this, iChannel service or this concierge service. We are building in the smartphone phase, like D menu or D market. It's a very various DOCOMO's wide array of services in the one icons, like a concierge service or GPS service, or even a mobile wallet service. We are adding this function for smartphone, the wireless battery recharging. You have no cord, cable, or it's a LTE. I explain later. It's a very fastest 4G services. To say correctly, 3.9G. And the emergency earthquake, you remember some March 11, we have very big earthquake, that we are informing such kind of some information to the smartphone. And in addition to that, we are starting some virus protection service or kids phone, including some GPS service and voice service. It's very cheap and a small one for kids. And maybe we are starting this winter the content billing. Billing is one important infrastructure for cellular phone. We can provide these functions for a content provider or service provider. They can charge their charge using our billing system. We are open to this function to the content provider or other sub-providers. And in order to educate the subscribers, we are expanding such kind of the lounge in the DOCOMO shop or branches. We educated some expert smartphone master. They have very good knowledge or skills for smartphone. And we have started the various new services for launch of LTE, long-term evolution. It's like some 4G services. We are starting some these USB types, modem, dongle, or tablet, and starting a smartphone. We are selling almost 6 million smartphones this year. And it's a kind of one segment broadcasting services, MMBI. It is very various contents or synchronize some cellular phone services. We have to, just 1 minute, okay. Or I would like to explain the various services using some wireless function, bike sharing, or this is a one-day insurance. You can enter just 1 day for, from the cellular phone. Or is medical insurance, or this is about electric saving system, or some other services supported by wireless services. Okay, I'll skip this one. You can check this presentation in the homepage, right? Can you open to it? Okay, okay, thank you. And I would like to explain DOCOMO USA. We are a subsidiary entity DOCOMO, and we have 5 or 6 subsidiaries in the United States. And we are supporting some Japanese experts or Japanese companies in North America. And we are starting a kind of the MVNO service in North America this last April. And it's very easy to sign up or no contract, and it's convenient and cheap in Japan. Or call Japan starts from 0. They're including some free time. If you need, if you have a 100 minutes free time, you can call to the 100 minutes to Japan. Or very cheap, 15 minutes plan at least, whether we can device the BlackBerry or some Nexus smartphone. Okay, thank you very much.
Thank you so much, Masaaki. That was a great introduction to your services. Fascinating to see all the innovations going on there. And now to our last speaker, Mr. Allan Kwan. Mr. Allan Kwan is the venture partner at Oakland Investment Partners. He joined Oak as a venture partner in 2007. With more than 25 years of information technology, telecom, and general management experience, he is a venture partner who consults on investment opportunities and portfolio company operations in Asia. Prior to joining Oak, he served in various executive roles at Yahoo, where he spent 6 years. More recently, he was vice president of Yahoo International following Yahoo's US $1.7 billion investment into Alibaba.com in August 2005. Prior to Yahoo, Mr. Kwan was chairman and chief executive officer of Asia.com. He also spent more than 6 years at Motorola, Inc., where he served as an officer and led the paging products division in Greater China. Mr. Kwan's high-tech career started with a decade of service at Nortel across engineering, product development, distribution, and marketing. Mr. Kwan holds a Bachelor's of Applied Sciences in Mechanical Engineering from the University of British Columbia in Canada, as well as an MBA from the Wharton School and a Master of Arts in International Studies from the University of Pennsylvania in Philadelphia. With that, the floor is all yours. Thank you.
Thank you. It's great to be here. Somebody's going to ask, what's a tech guy doing in retail? Actually, I'm standing in, but I'm hoping that I'll share a lot of the retail and restaurant business with you today. First of all, Oak, we're actually a firm that's been around for 33 years. We're quite understated, but we've been raising, and we're in the 13th institutional fund. The previous fund, Fund 12, was about $2.5 billion. This one's about $770 million. And we funded about 497 companies, about $9 billion total capital committed. And there's still about 87 companies active today. And of those companies, 25 companies are actually at about $100 million revenue. And some of these companies you may recognize, like Kayak and Genbang and Limelight and so on. In the retail portfolio, there are quite a few names I'm sure you recognize. We were in Baja Fresh, Cheddar's, Dick's Sporting Goods. We were there when there were 2 stores, and we built it into a 300 store before it went IPO. Actually, it's already listed. And PetSmart, Filene's Basement, Potbelly Sandwiches, Jamba Juice, P.F. Chang, I'm sure you guys all know. When we invested, it was 4 stores. Right now, there's about 200 bistros and about 165 fast casual restaurants in that chain. Whole Food, in China, we invested in a company called Chamei, Yica Yizuo, and it's mostly headquartered in Shanghai. Some of you in Shanghai may have eaten there before. Right now, it's already got 107 stores spread across the 5 big cities, as well as many of the smaller cities. And it takes a long time to build a great company in the retail sector, and usually for us, it's a 10-year horizon to build these companies. Whether they list or not, it takes a lot of effort. And we select really large growing markets, and we ensure these are a tremendous customer appeal for these retail and restaurants. We have to select real world-class CEOs, and that's really the key to success in most of these operations is really the management team. And I'll show you some of the challenges in China, some of the retail and restaurant business. First of all, it's really labor and training. And I'll share with you a picture that usually shows up in Jay Leno's Tonight Show, which is an article back in November 9th in Hong Kong Apple Daily. So to protect the innocent, this is a company actually listed in Hong Kong Stock Exchange, one of the major hot pot restaurants. And as they're trying to make the broth, the chef is actually smashing the bone on the floor to break the pork bone so they can put it back in the pot and boil it. So obviously he has a very strong scientific IQ. He knows that boiling temperature will kill all the germs. But it's definitely not a very kosher thing to do when you're serving in the restaurant business. So this goes back to all the challenges you can see in terms of labor, because all the laborers in China, most of the kids are from second-tier and third-tier cities. And the labor turnover is very high in the main cities. You have to provide housing, you have to provide all kinds of benefits for them to stay. And motivations are usually a very big challenge to keep those employees in place. So the training is part of the huge challenge for a lot of these companies to maintain a low turnover rate. But leasing costs, unlike US, whereby lease cost is low but labor cost is high, China actually, the malls, where most of these fast casual as well casual dining restaurants are placed, their it's very high rent. And if your rental cost is more than 15% to 19% of your overall cost structure, you're actually going to have a hard time making money over the years. So that goes down to site selection as well, whereby if you go to a site in a first-tier city and you're an early starter with only a few stores, you don't have the brand to negotiate a very good rate in the lease cost, then you usually start with very high lease costs in the first 10, 15 stores. And then as you enter the second-tier city expansion, you want to be there in the most highest traffic areas downtown, which means that you're still trying to negotiate very high-cost real estate in those second-tier cities. So just because second-tier cities seems to be low cost in the city centers and some of the major malls and traffic areas, you're paying almost the same price as you do in Beijing and Shanghai. So that creates a lot of challenges in terms of how you have to be very careful on how you select the sites to maintain a very strong profit formula in China. And the malls themselves are actually going through a very strong, very interesting evolution as well. As you understand that most of the shoppers today are mostly teenagers. And the 15 and 25 crowd today actually spend more time on e-commerce than they do shopping. So there's been a survey done in China that we found that 72% of the people, or the kids, go to malls, have no idea why they're there except to meet friends. And you have to keep them there for about 2.5 hours before they actually go buy something. So that's a lot of challenge for the mall operators to kind of keep everything interesting so that these people can actually stay and actually buy something among all the merchants that they have set up in the mall. So if you go to a mall, that developer doesn't pay a lot of attention into how to draw these traffic and how to draw these people and stimulate them to stay longer and actually shop, then you're going to end up going to a location that may have a lot of traffic, but there's no spending in the restaurants. So that's also another challenge that you'll face in terms of how the malls are evolving, and some of the new generation of malls you see in China, in Shanghai, for example, probably they're going to spend 40% of the efforts on actually creating interactive entertainment, and which means that you have to do American Idol shows, you have to do celebrity contests, singing contests, as well as special showings. So the kids actually stay there for longer than 2.5 hours, so they can go buy something. So this is the mall actually going through major changes throughout China, and above and beyond that, the management team, in terms of the founders and how they behave over time as they build from 1 store to 10 stores to 300 stores, and how they maintain that culture in terms of the operation culture and how they actually bring people in. So if you're running a restaurant that has a Taiwanese theme, for example, and you have a Taiwanese management team, and you're trying to hire Chinese labor as well as Chinese executives, so how do you navigate between those cultural differences of your employees, especially even the management team, and how they work well together in terms of their value systems in the store? And also pay scales. If you want to attract multinational executives from Yum, KFC, McDonald's, who's done corporate marketing before and trying to help your restaurant, they're going to be a very, very different pay scale than your startup restaurant that you're trying to operate in China. And how do you navigate that salary differences? If you pay them too high, then all the existing employees are going to be not feeling too good about their own pay. Then you're going to drive up your cost structure. So not only are you going to get hit on the lease cost, you're going to get hit on labor costs. The G&A is going to go up. And right now, the labor costs have already gone up anywhere from 17 to 25% in Beijing and Shanghai and major cities in the last year. So your profit formula is really under siege, along with all the pork and chicken prices increases. And so you can't raise the prices that high and that fast. So your cost structure is coming up. So in the next 2 or 3 years, we're going to see a real tough time for many of these restaurant chains to go IPO because they just don't have enough margins in the pool to sustain their business over time. So how do you, in terms of adjust your pricing strategy, and how do you bring in new menus so they can raise prices artificially? And how do you take off menus that's not really the high runners in your portfolio? And those are all the trick of the trade you have to really work on in order to build a real profitable chain in China. I want to spend some time jumping into the retail side. If you look at this, the January to October retail sales, I just highlight one thing, which is garments and footwear, which is roughly cumulative value of 620 billion yuan, but it only accounts for 4.2% of the sale. If you look at the sportswear, there's multiple tiers of brands, right? So most of you guys know Adidas and Nike. Fushing just talked about Li Ning. Then there's the third-tier brands in China, which most of the NBA stars are starting to wear. But I'm sure their sales are going to be hitting a plateau this year. I think most stars are going to be wearing sandals in the next few months. So, Anta, 361 Degree, Peak, Xtep, these are third-tier brands. But there's hundreds of these no-name brands on the fourth tier that's also making great money in the retail side in China. So I was looking at a deal 2 years ago in this little dinky outfit in Jinjiang, right, in Fujian. And that's kind of the capital of where all the runners are made. Right? And if you look at the comparisons in the second tier, third tier, these guys are all listed in the Hong Kong Stock Exchange, and they're talking about turnovers of $4, $5, $6, $7 billion, and huge market cap. And with a bottom line, net margins hovering between anywhere from 11 to 20%. And then we look at this little shoe shop in Jinjiang, and they have, at the time, it was about $380 million of sales. And I'm guessing they're probably over $500 million already. And their turnover growth is 56%, pretty humble in the first year. How do they sell that many shoes, right? And the fact is that in second-tier cities, you realize that all the women, they don't wear shoes. They wear runners. Right? It's just the most comfortable footwear. So when you talk about China compared to U.S., we think of sportswear as something that the NBA, Major League Baseball, or the football players are wearing and selling as an athletic item or as an outdoors item. But in China, many of this footwear is worn as a standard consumer daily wear. So these shoe companies are benefiting from all the second-tier city and third-tier city growth in terms of their whole GDP growth that we talked about earlier. And that's where retail is happening in China in a big way. I'm not going to spend too much time in the e-commerce side. If you've got questions later, we can talk about that. But it's still only 3% of the whole transaction value for retail. I'm sure many of you that's aspiring to be a startup and an entrepreneur, most likely going to gravitate to some form of e-commerce in China in the future. And that's something that's also a whole new can of worms in terms of the valuation, in terms of the challenges you have in that sector. So I'll close it off here, and I'll open to any questions later on with the panel. And glad to be here to share some of the experiences. Thank you.